The stock market is currently closed today, Monday, May 25, 2026, in observance of Memorial Day, so there is no live intraday trading activity to track. NVIDIA stock finished its last regular trading session on Friday, May 22, 2026, at a closing price of $215.33 per share, marking a daily drop of 1.90% on a massive trading volume of over 169 million shares. While a casual glance at that negative sessions data might make it look like the hardware giant is hitting a rough patch, the actual data points to a far more complex reality. Just a couple of days ago, the firm dropped its fiscal first quarter earnings report, posting an absolute blowout revenue figure of $81.6 billion, which is an 85% surge compared to the same period last year. They even beat out the high consensus estimates for adjusted earnings per share by hitting $1.87 against the predicted $1.76, while simultaneously raising their next quarter revenue outlook to $91 billion. Yet, despite dropping numbers that would normally send a typical tech stock straight into orbit, the share price slid backward as institutional managers quietly trimmed positions to lock in profits. The broader market narrative surrounding this massive company is built on an expectation of absolute perfection, where every single quarterly report needs to outpace human imagination just to keep the stock flat. When you log on to modern online investing platforms or browse mainstream investing sites, the general consensus portrays this asset as an unstoppable engine of modern infrastructure. People looking for regular investment help are constantly told that this is a must-own cornerstone for any individual brokerage account. This collective belief has pushed its total valuation up into the multi-trillion-dollar territory, a valuation that assumes global compute demand will scale upward forever without a single hitch. But the reality under the hood reveals a starkly different friction point that many retail traders using simple stock trading applications are completely overlooking. During the recent analyst call, management completely omitted China data center compute revenue from their upcoming guidance, openly acknowledging that geopolitical restrictions mean they are stepping back from that particular economic region. This deliberate omission is forcing sophisticated macro traders to rethink the long-term compounding rate of the business, creating a classic disconnect between public enthusiasm and institutional caution. To truly understand why the stock dipped after beating expectations, we have to look closely at the massive volume and order flow that dominated the final sessions of May 2026. Institutional block trades showed heavy distributions right at Friday's opening bell, when the stock initially attempted to trade up around the $221 mark, before getting aggressively sold down to an intraday low of $214.80. This selling pressure did not happen because the business is failing. It happened because large-scale funds use these highly liquid liquidity events to adjust their core portfolios. For instance, multi-asset managers who balance their holdings across traditional blue chips like Apple stock or alternative megacaps like Tesla stock often find themselves forced to sell down winners to keep single stock risk from overwhelming their broader funds. When an asset experiences a run that drives its price up past its historical moving averages, automated rebalancing models trigger sell orders irrespective of the near-term fundamental news. This systematic institutional trimming easily washed out the retail buying pressure coming from smaller accounts over the weekend. The dynamic playing out across modern retail platforms shows how widely sentiment can diverge among different tiers of participants. Users managing their money through self-investing accounts, whether they utilize a streamlined interface like the Robinhood app or trade via a comprehensive setup like the Interactive Brokers platform, are buying up fractional shares at record rates because the top-line numbers look pristine. On the flip side, wealthier allocators working with institutional services like Fidelity Wealth Management or automated models like Schwab Intelligent Portfolios are maintaining strict risk parameters, often opting for diversified vehicles like broad semiconductor index funds over direct single stock exposure at these elevated valuations. This creates a fascinating tug-of-war where Main Street traders are focused entirely on the undeniable structural demand for advanced microchips, while systemic pool operators are hyper-focused on the rising cost of capital, treasury yields keeping pressure on growth multiples, and the fact that the company's forward price-to-earnings ratio is currently sitting near 33 times earnings. If you peel back the layers to see how this business actually generates its massive cash piles, everything centers on its dominant hardware and software ecosystems. The company designs hyper-advanced graphics processing units and proprietary networking architectures that serve as the foundational backbone for almost every major cloud provider and enterprise data center on Earth. Instead of just selling isolated silicon chips, they sell complete computing fabrics, combining their hardware with a highly integrated software layer that makes it incredibly difficult for customers to switch to competing microchips from rival developers. This hardware dominance gives them an operating profit margin that hovers around 55%, a metric that is almost completely unheard of in the traditional hardware manufacturing space. Their commercial business model essentially allows them to dictate pricing terms to the biggest cloud companies in the world, because missing out on the latest generation of infrastructure puts those cloud providers at an immediate competitive disadvantage. While the modern focus is entirely on server infrastructure, this enterprise spent decades building its core capabilities in consumer graphics and high-performance PC components. Founded back in 1993, the company spent its early years focused squarely on improving the visual quality of video games, establishing a massive footprint through its popular line of consumer desktop graphics cards. This legacy retail business still pulls in billions of dollars every year, but it has essentially been eclipsed by the explosive growth of the commercial cloud segment over the last few years. The historical financial reports show an incredible transformation. If you go back to their fiscal reports from just a few years ago, the data center division was a secondary focus, whereas today it drives the vast majority of the company's multi-billion-dollar quarterly revenues. This massive fundamental shift is what pushed the stock from a mid-tier chip designer into a dominant global powerhouse, fundamentally altering how it is treated by institutional index funds and thematic exchange-traded funds globally. Comment below how many shares of NVIDIA stock you currently hold in your portfolio right now, and let me know if you are buying this post-earnings dip or waiting for a deeper correction. Looking out into the final months of 2026 and heading into next year, the ultimate trajectory for this stock will be decided by how reality stacks up against the market's massive structural expectations. The optimistic outlook hinges on the global rollout of their next-generation chip architectures, which are designed to deliver massive leaps in computing efficiency and hardware performance. If production yields remain high and cloud providers continue to allocate huge capital expenditure budgets to expand their data centers, the company could easily beat their current $91 billion guidance and push the stock back up toward its 52-week high of $236.54. Furthermore, management's aggressive decision to initiate a massive $80 billion share buyback program and dramatically raise its quarterly cash dividend to 25 cents per share provides a highly supportive floor for the equity price, signaling to Wall Street that corporate leadership believes the underlying cash generation is fully sustainable. However, the contrarian view presents several distinct risks that long-term investors using an online investment platform must carefully weigh before committing more capital. The biggest near-term risk is the complete loss of momentum in the Chinese commercial market due to shifting international trade rules, which forces the business to find alternative international buyers to absorb their excess chip supply. There is also the growing threat of internal chip development among their largest customers. Tech giants are pouring billions into designing their own in-house silicon to reduce their long-term dependence on third-party suppliers. If these custom chips begin to handle even a fraction of the core workload, the hyper-premium pricing power that this company currently enjoys could face real pressure. If profit margins compress by even a few percentage points, the market will immediately re-rate the stock down to a lower valuation multiple, catching over-leveraged retail traders completely off guard. When you weigh the two sides, the tension between what the market expects and what the numbers actually show tells a clear story of an incredibly healthy business wrapped inside a hypersensitive stock. The underlying business is executing at an unbelievable level, proving that real-world demand for advanced hardware is robust, sustained, and highly profitable. But because the market had already priced in a flawless execution, the stock experienced a classic sell-the-news pullback when management pointed out real-world geopolitical hurdles. For long-term capital allocators using a Fidelity trading platform or a SoFi active investing account, these periodic pullbacks represent normal, structural, healthy breathing room for a highly liquid asset, rather than a systemic failure of the underlying business model. Navigating this landscape successfully requires looking past daily noise and understanding the structural trend lines governing global computing infrastructure. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.